Market reaction this morning to the jobs number. Let's check in with Bob Pisani, see what's moving here. Bob, do you think it's orderly?
Yes, and I too am shocked by this number, 336. The down on the floor, they were talking 140 to 170. They wanted it just below the expectation, and particularly, Sarah, the incredible upward revisions in July and August, really, really strong. So job market strong, but there's a curious reaction in the stock market. I want to show you something. The usual laggards are there. So utilities, banks, REITs, some of the consumers. The reason consumer discretionary is so weak is because Tesla's down 3%. That is an outside weighting in consumer discretionary. But look what's holding up comparatively better. Cyclical stuff, particularly commodity-based things are holding up. Energy, China holding up better. Metals and mining stocks holding up better. Positive. Freeport-McMoran's positive. Oil and gas exploration, you might think, oh, well, that's because of Exxon, Pioneer. But actually, some other things are going on there. Oil rallied. Copper rallied on the jobs report. That's rather interesting to see here. There you see Exxon down. But look, Occidental, Marathon, Petroleum, Hess, right across the board. Energy is to the upside. So I think, Sarah, you put your finger on what the core story. It's inflation, stupid. That's what we care about. And average hourly wages, month over month, below expectations. Year over year, below 4.2, below 4.3 expected. So what do we have here? We have wage growth, which is the thing we care about, moderating, going in the right direction. But job growth is still strong. So what does this mean? It means consumers still have jobs, but inflation is going down. This would generally be good news for certain sectors. It would certainly be good news for cyclicals that are holding on. And even some consumer names. Home Depot is holding up well. Industrial Caterpillar is actually up in the Dow this morning here. So I'm not trying to sugarcoat this. We were all shocked. This was a big outlier. But there may be a modest silver lining here. I don't think wage inflation going in the right direction down and job growth stronger than expected is necessarily a catastrophe, even if it is surprisingly strong. So I'm trying to explain why the market is reacting the way it is. I think that's the explanation.
No, a few months ago, this would have been a Goldilocks report that the market would have rallied off of. Lower inflation, but still strong jobs growth. That's a soft landing. They're getting hired at lower wages than they were. That's a good thing. But I think in this stage, where the higher for longer is just really getting psychologically priced into the bond market, a lot longer.
But the bond market is up because the economy is really strong still. That's the message. It's not up because the economy is weak. It's up because it's strong. Daly had the key point here. I think they're going to stay. They're going to stay right here. Look at these numbers right now. Why would they keep moving until they break things at this point? Don't they have that balance? Aren't they worried about breaking things?
I think they
Powell
may
said
be,
he is.
Bob.
Powell
I
said
think
he
there's
is.
a concern amongst equity investors about that. Again, we don't know. We hope nothing gets broken, as we like to say, which simply means a significant market reaction in some area that we don't anticipate because of concerns as a result of something failing or something going awry because rates are so much higher than they were.
I think they're going to stick. Daly had it there. You had the right, as always, you brought up the right quote there. That's, I think, the consensus at the Fed right now.
There are many Fed members that want to keep raising rates on that committee, including some of the governors. Like,
how about the one guy? What does he want?
Not sure. I mean, I think he probably leans towards stay. He doesn't want to break anything.